This is Daybreak Asia. We're counting down to Asia's major market opens. And Haidi, we've spoken so much this year and about this so-called last mile for disinflation. And now it seems like that's something that's being acknowledged by the Fed Chair, Jay Powell.
Yeah, the stickiness of really very positive, robust labour market numbers and really broader eco numbers that we've seen from the US, right? And in a sense that what Jay Powell said overnight wasn't much of a surprise, but really, I guess, adding more clarity to the willingness of the Fed to hold rates, as he says, as long as they need to be at these levels to combat inflation. So we are seeing, of course, that big reaction across global bonds and the US dollar, and that's passing through to Asian FX in particular today.
Yeah, absolutely. We've been tracking that Japanese yen very closely here, very close as well to that 155 mark. A lot of different analysts in the market, Bank of America, for instance, among those saying that 160, that's the new line in the sand that you want to be watching out for. We do often look for any sort of jawboning at this time of the day, but no lines as yet on that. But certainly we know that Japanese government officials are watching these levels very closely. And indeed, we actually heard from the finance ministers of both South Korea and Japan saying that they are seeing some serious or sharing their serious concerns about the weakening of their local currencies. But a weaker yen, it's a dynamic that we know has been assisting or aiding Japanese exporters in particular. And today you're actually seeing Japanese equities a little bit high to the open. A bit of a standout because perhaps most other markets could trade in the red so far today, given as well what we had in the US session overnight. But today we are seeing Japan just moving a little bit higher. Eco data to note as well, because we actually just had March exports data. And again, the numbers from Japan a little bit better than expected here. So a rise here of 7.3% on the year, better than what economists had been expecting. So that's the state of play there. Let's switch on and take a look at what's happening in Korea so far as we come online. Again, actually, Korea is a little bit high here. It's interesting because growth stocks or tech stocks in particular were the key focus in the US session overnight. Today, you're seeing that KOSDAQ index actually outpacing some of the broader gains that we're seeing for the Kospi so far. But it is still that story, again, that focus on the local currency. Again, just a little bit of weakness of the dollar. But Haidi, put it in context. I mean, we've just seen the best 5-day run for the greenback going back to 2022.
Yeah, and sort of the broader direction, right, potentially getting a little bit concerning for, in particular, some of these emerging market Asian currencies, plus the yen, just seeing further sustained weakness there. Potentially 160 is a level to watch if we see that Korean and Japanese finance chiefs sharing their concerns on their weakening respective currencies. Take a look at just the start of the trading session here in Sydney. We're pretty flat at the moment. Watching in particular some of the mining names, and we're watching with the sort of lending given to some critical mineral firms that could see a reaction across those names. And we're also hearing from the copper boss for Rio Tinto talking about building mines being better than buying. So watching that across the mining and mineral space. When it comes to Australian bonds, of course, also seeing potentially really that follow through as we see US yields sitting still at 2024 highs. And we're also seeing across the short end in particular that 2-year climbing past 5% for the highest since November. The Aussie dollar actually holding pretty well, perhaps on sort of some of the resilience that we see across the commodities complex. 64.13 is where we're trading, and oil unchanged, pretty steady at the moment. These Middle East tensions and the Fed outlook continuing to be in focus. And take a look at treasuries, and of course this was really the big play, and we'll continue to see that reverberation across Asian and global bond markets. Take a listen to what we heard overnight.
We'll need greater confidence that inflation is moving sustainably toward 2%. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. The performance of the U.S. economy over the past year has really been quite strong. Come what may, we remain strongly committed to returning inflation over time sustainably to 2%.
Let's bring our next guest. Herman Lee is a senior macro strategist at Lombard Odier. And Herman, you've pulled back when it comes to easing expectations from 4 rate cuts expected this year to 3. Did the commentary last night sort of meaningfully change the outlook for you?
We maintain our base case despite Chair Powell's comments last night. Certainly, the first 3 months of the year, we have seen a fairly significant positive surprises on growth and inflation, and that's going to make the Fed slightly uncomfortable with potential the start of the easing cycle in, say, June. So that's certainly going to be a more of a borderline call here at this juncture, in our view. But if you think about the broader macroeconomic context, wage growth is not accelerating, possibly due to changes in the labor market. And the economies outside the U.S. are certainly seeing continued disinflation, especially in China, where we continue to have a very low inflation, and certainly the country is still trying to maintain or even gain market share with low prices. So in that kind of context, we still think it's quite likely that we'll see additional 30 to 60 basis point decline in the core PCE measure in the next 12 months. And I think that's a good enough context for the Fed to start cutting. This is something that the median dot in the FOMC projections shows, despite the rise in GDP forecast and inflation, still the median that looks for those 3 cuts. So our base case remains 3 cuts. We wouldn't be terribly surprised if they reduce it to 2, but that's not our base case at this juncture.
How much further to go for the US dollar rally? I know that you're overweight when it comes to the greenback.
Well, we have to acknowledge that in the near term, the dollar will continue to be the outperformer, especially against the other reserve currencies, especially the European currencies. The economy is doing pretty well. The GDP growth performance and the inflation outlook definitely have diverged quite substantially in past few months. So in our view, it's quite likely that the European Central Bank and the Bank of England will actually do a little more in terms of rate cuts this year compared to the Fed, and they'll also likely move slightly ahead of the Fed in starting the easing cycle. So, against that backdrop, we think it's quite likely that at least in the next few months, the dollar continues to receive a bit of support against the other currencies. And certainly a tricky geopolitical backdrop, which tends to boost energy prices, which, by the way, is rather helpful for the U.S. compared to the other developed markets. There will also be another factor driving the currency higher. So in the near term, we're positive on the dollar.
And the flip side of that, of course, as you said, is weakness we see in other currencies. But the Japanese yen is really standing out, very close to 155 at this point. Is that still the level that you're tracking for intervention?
So we in the market are basically moving the goalpost around, and I have to acknowledge that we don't even have a pretty firm consensus on what the trigger is for the Japanese Finance Ministry to intervene in the foreign currency market. Despite the slightly mixed language from Finance Ministry, we think the recent rhetoric from Finance Ministry and also the meeting that it held with the BOJ and FSA suggests that we're pretty close to an intervention. We wouldn't rule out 155 for dollar yen to be the trigger for the markets, especially because voters are unhappy with the currency weakness, and potentially the recent move is a bit excessive compared to the underlying fundamentals for the economy. So we think it's possible that the Finance Ministry tries to intervene when the currency pair dollar yen punctures through 155. If it goes further from there, it certainly starts affecting the inflation outlook for Japan. And this is an angle that BOJ Governor Ueda has been highlighting in his recent speeches. So our view is we're pretty close to the intervention level. We don't rule out 155 as the trigger, but maybe the weakness in the currency might be slightly on the excessive side.
Let's speak about inflation hedges, because you mentioned commodities earlier, and gold is really standing out this year with that run-up that we've seen. Would you still find it attractive at these levels? And if so, how are you looking to play it as well, getting exposure to it?
So in our portfolios, we do have strategic asset allocation to gold, and we have benefited from that position this year. We think, the gold prices have actually detached quite a bit from real rate in the U.S., potentially due to the hedge fund positioning on the precious metal, on top of aggressive buying from some emerging market government, including China. So, that divergence is a bit tricky from our perspective. So we're not chasing this at this juncture, but we do have that position in the portfolio. And if the price corrects a little further from here without any of the geopolitical risk being resolved, then we're certainly be biased to consider adding the metal to the portfolio. But currently, we're more neutral against our benchmark, but we do have that 2 to 3% exposure in our balanced portfolios.
All right, Home and Lee there, Senior Macro Strategist at Lombard Odier. Thanks so much for your time this morning. And still ahead this hour, we discuss the upcoming Bitcoin halving with Emergent X Digital Asset Insights. Hear why they think the event is already well priced in as we see Bitcoin trading back toward this year's highs. But first, the latest on the German Chancellor's China visit as Beijing pushes back against pressure to rein in his country's powerhouse industries. Details next. This is Bloomberg. The International Monetary Fund has inched up its expectations for global economic growth this year. It now sees output expanding 3.2% worldwide. The fund's latest World Economic Outlook report cites strength in the US and some emerging markets, while warning the outlook remains cautious amid persistent inflation and geopolitical risks. Plus, it's urging China to find ways to offset headwinds from its property crisis.
With an economy that has potentially still relatively weak domestic demand, but is growing, then there will be an increased reliance on the export sector, and that is something that, in the context of very tight trade tensions, could be complicated. And so certainly there would be, in the interest of the Chinese economy to develop ways of sustaining domestic demand.
And Chinese leader Xi Jinping has told German Chancellor Olaf Scholz that a surge in China's clean tech exports has helped cool inflation. His comments suggest Beijing may not be swayed by European and US pressure to rein in Chinese manufacturing capacity. Our Greater China editor Jenny Marsh is with us. And Jenny, we just heard it from the IMF there, that pressure that we're seeing in China's domestic economy, its reliance on exports. There had been a sense perhaps that Beijing would sort of be a bit more amenable or willing to absorb this message from the US, from Germany, but it doesn't appear to be the case perhaps.
Absolutely. I mean, President Xi Jinping came out yesterday very strongly defending China's industrial policy, framing it as a good for the world in two ways. One, cheap Chinese exports are easing inflationary pressures, which have been a problem for the US and Europe. And also, China's advancement in these sectors is a good thing for sort of a country's efforts to decarbonize. So he certainly showed no sign of sort of relenting, but also he doesn't really have a lot of space to. As you just mentioned, the domestic demand in the Chinese economy is still very weak. We saw that in quarterly data that was released yesterday. Consumers still really just spending on the daily essentials and not sort of spending on eating out and, other things that would buoy the economy more. And also, the trade policies of the US have sort of pushed China back to this need to manufacture. President Biden has been sort of kneecapping China's access to high-tech chips, imposing tariffs on other parts of the US economy. So it's really sort of doubled down on President Xi Jinping's need to make sure that the domestic manufacturing industry is able to provide China with the high-tech equipment that it needs. So there's very little space for Xi to pivot, even if he wanted to.
Jenny, was there much space in talking about the geopolitical situation when it comes to China's relationship with Russia and what potentially Beijing can do in terms of pushing for what it wants the restoration of peace?
I think China's position on this is very steadfast and has been clear all along. They're a big backer of Russia, but they say they will engage with peace talks only if both sides are at the table, essentially. So, Scholz is trying to really push Xi to sort of use his influence with Putin, who is reported to be coming to Beijing in May to try and bring some sort of peaceful resolution to this. But, there's only so much Xi can or is willing to do. Having said that, we did see in China's March export data a pullback from Russia. So exports slumped for the first time since March 2022. So that kind of shows that maybe there's some sort of moderation in the economic engagement. I think one thing for China has always been they don't want to cross red lines that would lead to sanctions or hurt their own economy. So they're playing a very sort of careful game. And, when Yellen came to China early this month, she warned again that, if Chinese banks were seen to be helping Russia's war machine, they could face sanctions. And that's certainly something that Beijing will be careful to avoid.
Greater China editor Jenny Marsh there with us. Meanwhile, China's position in the South Pacific could hinge on elections today in the Solomon Islands. Polls opened a couple of hours ago. Results are being closely monitored in Washington, Beijing and Canberra. Our government reporter Ben Westcott joins us now for more. And Ben, what are we expecting and why are there so many international eyes on this election?
Yeah, you're exactly right. So the polls opened this morning at about 7 a.m. in the Solomon Islands, and they're expected to close about 4 p.m. But we're not expecting a result today. First of all, the votes need to be counted from across all the different islands. There's more than 90 islands in the Solomon Islands. And then after that, they need to, all the lawmakers need to meet in the capital, Honiara, where they will hammer out who exactly is going to be the Prime Minister. Now, the current Prime Minister is Manasseh Sogavare, and he has moved his country a lot closer to the Chinese government. It was under him that Solomon Islands switched its recognition from Taiwan to China, its diplomatic recognition. And then in 2022, he famously announced that Solomon Islands had signed a security pact with China, which set off alarm bells from Washington to Canberra and led to a massive diplomatic outreach. Now, if he wins another term in office, you would be expecting the Solomon Islands to move closer to China once again in forms of business, in forms of security. However, if he is denied a second term, it would actually be his fifth term as Prime Minister, but his second consecutive term, then he would be given, then the successor would almost certainly want to reevaluate those ties. One potential candidate has even suggested that relations with Taiwan might resume under his government. So a lot at stake here.
Yeah, certainly a lot at stake. Just get through some of the other international outcomes we can expect, and also whether this was a sort of relationship that there was a perception, at least in Australia, perhaps that it had been ignored, from Australia and others in this region. Is there a window for other Western democratic powers to re-establish some sort of tie, do you think?
Look, it all depends on who is the Prime Minister later this month after the outcome of the election is known. So under Sogavare, he has been a very clever leader of the Solomon Islands, using the sort of strategic position, its new geopolitical importance, to get outcomes for it. He has been invited to the White House twice, something that previous leaders of the Solomon Islands can't really say has happened for them. On top of that, he's been courted by China. He's been courted by Australia. And that has led to millions of dollars in support for his government and for his country. Now, if he was to leave power, certainly there'd be a big push by Australia and the US to embrace the Solomon Islands and pull it back towards those historic links that it has that go back to World War II. However, his successor would be courted very energetically by the Chinese government. The Solomon Islands is effectively China's closest ally in the Pacific, and they wouldn't want to lose that, whether the Prime Minister is Sogavare, Peter Canaloria, or Matthew Wale.
Right, and as you said, Ben, we'll be watching for the outcome of that vote count, but that was our government reporter, Ben Westcott, in Canberra. And let's turn now to the conflict in the Middle East, and the US is going to be imposing new sanctions on Iran, targeting its missile and drone program following the weekend attack on Israel. White House National Security Advisor Jake Sullivan says the sanctions could be unveiled in the coming days, and the US is coordinating with G7 nations and allies on what it calls a comprehensive response. New Zealand's Prime Minister Christopher Luxon has added his voice to the international calls for restraint following that attack from Iran on Israel. He told us his government continues to call for negotiations and an immediate humanitarian ceasefire in Gaza.
I think we join with the rest of the international community. We are concerned, and what we don't want to see is don't want to see the escalation of conflict in the region. It's the last thing the region needs. We want to see people showing restraint, and most importantly, we need the parties and the sides to get around the negotiating table and to commence the Middle East peace process, ultimately with a vision of delivering a two-state solution. So that's a long-standing position of ours, and we've been calling consistently for an immediate humanitarian ceasefire and a cessation of hostilities.
Do you condemn Iran for the attack? Do you condemn Israel for its attack on Damascus?
We condemn Iran for the attack. I mean, it was unprecedented in terms of what we've seen in the region. But what's important now is that actually all parties show restraint so that actually the region can get back into a process that's important.
What are you most concerned about if there is an escalation? Is it to do with perhaps impact on supply chains as well as the global economy?
Well, I mean, to be honest, our primary thought is actually with the suffering and the pain and suffering of the people in the region. It's been a region that's gone through a tremendous amount, and we've seen the conflict in Israel-Gaza. We think about the suffering of people in Palestine, but also in Israel as well. And that's something that we really want to see stability in the region, because it's actually about people and it's about their livelihoods and their lives, and it's been horrendously disrupted in a catastrophe. So we really want to make sure that we actually see peace break out in that region.
Given rising geopolitical concerns, do you see a need for New Zealand to realign itself with traditional partners like the Western world, like the US? How are you looking at it?
Well, like I just say, New Zealand is a country that, like many other countries, has an independent foreign policy that acts in its own interests. What is very much in our interests is within the Indo-Pacific region to see stability and security, but also to see prosperity and peace break out. And so we know there's heightened tensions. There's certainly a lot more geopolitical competition in our part of the world now. But what's important for us is to make sure that we build and deepen relationships with like-minded countries that stand up for the values that we believe very strongly in, but equally that we're able to work with all countries across the region.
That was New Zealand Prime Minister Christopher Luxon there speaking with our colleague Haslinda Amin. And you can watch us live and catch up on past interviews on our interactive TV function. That's at TV Go. You can also dive into any of the securities or the Bloomberg functions that we talk about, plus become part of the conversation. You can send us instant messages during our shows. This is for Bloomberg subscribers only. Do check it out at TV Go. This is Bloomberg.
We should, barring major shocks or surprises, decide on a first rate cut at our next meeting on June the 6th. I would then argue, furthermore, in favour of a policy of pragmatic and agile gradualism. There will have to be further cuts this year and next.
ECB Governing Council member Francois Villeroy de Gala on the central bank's rate outlook. Take a look at how European futures are opening. We are seeing, of course, some reaction across the Asian session when it comes to repricing over Fed Chair Jay Powell's comments over rates being held as long as necessary at these levels. We did see European stocks really sinking in the worst day since July. These rate fears, the war fears, quite frankly, as well at play here. We are seeing potentially a little bit of a recovery in sentiment. Euro Stoxx 50 futures up by about 0.5%, and German DAX futures looking mildly positive there as well. But really that biggest one-day decline for the Europe 600 index since July, with mining and banks potentially recovering today.
All right, just taking a look at some lines that are crossing the terminal here. Singapore is pushing out its non-oil exports rather for the month of March. Here you can see they've actually fallen quite substantially past what economists had been expecting. So a drop there of 20.7% on the year. That was far greater than the analysts or economists rather had been expecting, for a contraction of 7.4% instead. As well, on the month, we've seen a drop of 8.4%. That's roughly double, again, what economists had been predicting. Electronics, we've seen weakness there as well. They're down 9.4% year on year. So not great export numbers coming through from Singapore there. Haidi, Singapore dollar trading fairly steady at this point in time.
Yeah, and we are seeing kind of that broad downside across major markets that are trading at the moment. Bell, Australia kind of just keeping its head above water. We're seeing a little bit of leadership there from utilities, some of the oil and energy related names there as well, as we continue to see the demand side being supported by these Middle East tensions. But the Nikkei 225 off by about 0.3% there. The divergence, interestingly, even as we see potentially dollar yen approaching 155, 160 is that level we're watching now. That divergence in terms of the beneficiary effect on Japanese stocks seems to be weakening. We could see that widen further should the yen keep weakening amid these ongoing Middle East tensions, and of course perhaps more potently the ongoing strength that we see in the US dollar. The Kospi is up about 0.3% there. We've seen the decline in the won in particular playing into some of these auto bets, but the Kospi of course seeing a little bit of a bounce back. It did see the biggest decline in about 5 months in the previous session, so maybe just a little bit of equilibrium there. Kiwi stocks looking pretty muted. We did get some weakness, in fact quite a bit of volatility in the Kiwi dollar with the inflation number. Inflation slowing, the domestic price pressure side continues to persist there, so we could see sort of further ongoing downside when it comes to the Kiwi dollar. And of course, it is earnings season, particularly when it comes to the focus on banks in the US. Bank of America shares falling the most in a year. It reported elevated expenses and charge-offs for bad loans, but it also did join the 4 other big US lenders in beating expectations for trading revenue. It is a rare sweep, but let's bring in our Bloomberg Intelligence senior industry analyst Matt Ingram for more. So across the board, seemed pretty healthy. What really jumped out to you?
Yeah, g'day Heidi. Look, I think there's 3 things. As you just mentioned, trading was extremely strong. That was a mixed bag. Bank of America was pretty strong in equities. Goldman, as we saw yesterday, was very strong in fixed income. But yeah, either both fixed income and equities or just fixed income. I think that's on the back of really strong client volumes. We've now really well and truly moved past the pandemic. Business activity is back to normal. I think questions about what the Fed's going to do this year are maybe starting to raise questions in the clients' minds, and therefore that's really keeping a good amount of activity in fixed income trading, particularly that hedging type trading. We also had commentary from both Bank of America and JP Morgan saying that client activity and investment activity in equities is really strong. As you also mentioned, investment banking, for me, that's the biggest standout and the biggest surprise. On this side of the pond, it's been extremely weak. Australian and Asian banks are really struggling in investment banking. But again, we're seeing really good deal flows. Surprisingly, most of all, probably in mergers and acquisitions. That's really healthy. The third one, and I think this is a good sign that the banks have broadened their business models post the pandemic, that's the wealth management inflows. We've seen big wealth management inflows across the board. That's really high margin money. It's also really good for bank returns. So I think those were the 3 standouts. Bank of America, obviously the impairment is what hit the stock today. That was a standout versus its other peers. JP Morgan wrote back some money in their provisions last week. So I think those are the standouts.
And Matt, we've seen the banks benefiting from the Fed's hiking cycle. Do you see that outlook or that trend staying intact, or are we going to see it weakening instead?
G'day, Annabelle. Yeah, look, our analyst in the US, Alison Williams, has made a good call on this. The net interest income is still at really close to record levels, but certainly the margins and the outlook are tapering. Now, again, what I said yesterday, that comes back to what the Fed does as to how much impact that has. But certainly we're expecting the peak in net interest income to be in the rearview mirror. And the outlook from the banks is certainly, it's probably not going to be as good as it has been. But are we going to see the margin collapses that we've seen here in Australia and for banks like HSBC potentially? Probably not. The margin outlook in the US seems to be much stronger than it is over here.
Has the diversification helped?
Yeah, Heidi, absolutely. And look, I think something that came out of the financial crisis was that you cannot run a business through the cycle with trading and investment banking. They're very lumpy in terms of revenues, they're very capital intensive, and shareholders don't want that. They want a dividend. So the banks moved more towards lending and more towards wealth management, which I mentioned before. Those are both far more consistent through the cycle, but also wealth management really juices returns. And we saw that with Goldman yesterday with that 15% return on equity. That's healthy for a business to generate through the cycle. So I think that diversification's coming to the fore now with good revenues across the board, but they're going to be held up by wealth and lending if those trading revenues drop off.
All right, Matt, thanks so much for your time. That was our Bloomberg Intelligence Senior Industry Analyst, Matt Ingram there. And we're going to have an exclusive interview with JP Morgan Chase CEO Jamie Dimon in the second season premiere of The Circuit with Emily Chang. You can see it here on Bloomberg Television at 6 p.m. Wednesday. That's New York time, 6 a.m. Thursday if you're watching from Hong Kong. And some breaking news as well, just crossing the terminal relating to the trading that we're seeing today over the session, because we've actually had the Asian benchmark, the MSCI Asia Pacific Index, raising its year-to-date gain. So we're pretty muted so far in the session, but certainly enough of a pullback over the last few days to bring us back down to where we were really to start the year. It is really that repricing that we're seeing in terms of the outlook for the Fed. It's been a really, really big readjustment around expectations, given we earlier this year had 7 cuts priced in, now around that 2 to 3 point. With indications perhaps we'll see none at all, and really the moves as well, those higher Treasury yields. But the PGIM CEO, David Hunt, he actually sees bonds making a comeback in the next few years. He told us more about the factors behind a migration from money market funds to other assets.
You know, certainly at a higher level of interest rates relative to money market funds, and as we begin to see rates peak and then decline, duration begins to look a little bit more attractive. But there are 2 other things that are going on which are at least as important. One is that the big pension funds with higher rates are actually better funded. And so they actually are using this as a chance to de-risk, and that means for them, they are moving money into fixed income. And the second is that, we have the continued demographic trends going on, not just in this country, but around the world. And retirees need income. So we are in the process now of this huge shift from accumulation products to decumulation and income products. And those need fixed income. So if you take the kind of short-term shift, you add to them 2 structural shifts, we think over the next 3 years, we really are going to see bonds are back.
This sounds like a new regime, and I'm going to give your team a bit of a shout-out because you're a modest man. Mike Collins, Greg Peters, Robert Tipp, just absolutely phenomenal. Pre-pandemic, really defining that bond market regime of yesteryear. Can you talk to me about how different this regime is going to be compared to that one?
We think it will be different. And you're right. They were right on the lower for longer for quite a long time in that. And then more recently, our call has actually been that we're going to be higher. So if you go back 6 months, we were very early to hey, we're looking at kind of 2 cuts for 24 when the market was pricing in 7. And we held with that view, and the market's kind of come back to us at this point. So we pride ourselves on taking, I think, considered non-consensus views that are long-term in nature rather than simply trading views.
PGIM CEO David Hunt there speaking with Bloomberg's Jonathan Ferrer. Take a look at how we're seeing bonds reacting, of course. We saw the big moves across global bonds led by treasuries as those sort of not new messaging when it comes to what we heard from Fed Chair Powell, but certainly the reaffirmation of the fact that interest rates in the US could stay as long as they need to be, kind of in his words. And we are seeing that catch up, if you will, for Australia and New Zealand bonds there. there. We're seeing the 3-year bond yield in Australia climbing to the highest since December. We're also seeing some reaction to that slowing of Kiwi inflation to 4%. That was a weaker since mid-2021. However, there is still seen to be some pretty stubborn domestic price pressures that are sort of weighing on what we're seeing across markets as well. But the yield, certainly the yield curve here in Australia in particular, shifting higher in the morning session. We've seen some of these yields in the US really sitting at the highest for the year, that 2-year putting that 5% level in play in particular. Well, coming up next, hear why Emergent Digital Asset Insights expects a long-term rally in crypto markets ahead of the Bitcoin halving event. This is Bloomberg.
All right, taking a look at crypto prices this morning. You've got Bitcoin actually very, very close to its year-to-date high and record high, actually. It's all this market move that we've been really tracking over the course of this year, led by the optimism and the inflows around spot Bitcoin ETFs, but also ahead of the halving event. Lots of different views on what halving will mean for prices over the nearer and also more medium to longer term. But here is a look at what halving actually means and how it could affect prices in turn. The Olympics, Sporting World Cups, leap years, and Bitcoin halving. They each happen every 4 years, and in the crypto world, halvings typically meant a boon for prices. In a nutshell, Bitcoin halving means fewer new tokens are issued. That's because Bitcoin miners, who validate blockchain transactions, receive 50% less of a reward for doing so. At Bitcoin's launch in 2009, miners received 50 new coins per block. Post the halving in 2024, that'll be cut to just 3.125 Bitcoin instead. In the past, we've seen prices spike following the event. For example, in 2012, when the token jumped by 8,000% in the following 12 months. This time around, the prospect for further gains is unclear. Some analysts say the halving could trigger upside of at least 80%. Others argue the event is already baked in, particularly as Bitcoin's already risen to fresh records this year, which brings to mind a familiar phrase: past performance does not guarantee future results. All right, let's bring in Esme Power now. She's CEO at advisory platform Emergent Digital Asset Insights. And Esme, I'm curious for your views on this Bitcoin halving. How much do you think has already been baked in at this point, or can we expect to see a significant rally from here?
Right. Again, Annabelle, thanks for having me. So I would say that overall, I have a bullish secular view in terms of the future performance of Bitcoin. I would say that overall, there will be 2 key changes. First, it will be around market structures, and I do want to draw in the Bitcoin ETF that has been approved, as well as Ether ETFs in Hong Kong. And the second would be around how we should position as investors. So first of all, we always see that with limited supply, so that's going to bring in the blue chips to perform and rally first, and then we're going to see that stream channel into the meme coins, and so in terms of the different subsectors. Very similar to equities.
So you think this next rally is going to be really led more by institutional investors, I guess, coming into the market?
Yes, absolutely. I think there's been a few cases of crying wolf, whether to deepen or whether it's RWA tokenization. But I think for this round in 2024, I'm very bullish for 2 reasons. The first would be around the regulatory clarity. We've already seen many sell-side brokers, broker-dealers coming in and offering infrastructure. And the second thing will be around the infrastructure, including on-ramp, off-ramp. And the second thing is I do want to emphasize, if I were to bring in spot ETFs, so we do have in-kind redemptions, which is going to channel more of this AUM into regulated exchanges and also trading venues.
Yeah, so in-kind is a quirk or not quirk, but it's a typical ETF structure. It's not being followed in the US for its spot Bitcoin ETFs, but it is going to be followed here in Hong Kong. What sort of inflows are you expecting?
Right, absolutely. I think we can start with the base case that what we see in Hong Kong in terms of spot ETFs is only going to be a fraction of what we see in the US, right? But I do want to caveat that with what the market participants we should be focusing on. And I think on that front, we should be looking at the southbound Chinese volumes coming into Hong Kong. And what I'd like to highlight is in terms of the market participants, we do see that the participants would be China AMC, Harvest. These are all major buy-side platforms in China. And I think that's going to define what the participants would be when it comes to AUM inflows.
These spot ETFs, though, crypto ETFs in Hong Kong, what would be the ways that you would expect to see Chinese money coming into them? Because they wouldn't be eligible for inclusion in the Stock Connect scheme at this point in time.
Mm-hmm. Right. Again, I think overall it will be a matter of time, but I think near term it will be more of the offshore funds that in Hong Kong that are ready to allocate. And I think overall, right, if we were to, it's more of a barbell strategy. So of course, I think it will be quite channeled. So first of all, we're going to see more easy on-ramp offering around the whole ecosystem, for example, stable coins. And then afterwards, it's going to funnel into RWA tokenization. So we see, for example, Singapore, there are a lot of that examples, and many of them are basically setting up shop in Hong Kong. So I think overall, will be a full of confidence for the overall Hong Kong ecosystem.
You've talked about how, as an asset class, it's evolving into a full ecosystem as opposed to just as an alternative investment or a store of value or a hedge. What are the implications as this continues to happen?
Right, I would say that the overall ecosystem is that previously in previous cycles, given that there's very high retail participation in cryptocurrencies, so we see a rather cyclical nature in terms of price performance. But again, tying back to the point of market structure changes, so we're going to see with more institutional adoption, slowly with regulations, it's in fact inevitable that the Sharpe ratio is going to come down. At the same time, we're going to see more price support as we see in terms of Bitcoin inflows into the Bitcoin ETFs in US. So we're going to see a very similar mirror image when it comes to Hong Kong spot ETFs. And the second thing is that I would say that Hong Kong is basically setting the stage for, and also a precedent for many other jurisdictions to follow.
Are we going to see a bit of a washout when it comes to Bitcoin miners? Because even though we've seen kind of the confidence being struck ahead of the halving, it does appear that investors are concerned about a pretty sharp loss of revenue.
Right. Again, I would say that referencing to previous cycles, it is in fact inevitable that the miners will wash out. At the same time, I think overall, so there's going to be more innovation around that. So I understand that some of the miners, they have been pivoting closer to other revenue models. So for example, staking. And the second thing is that Bitcoin by itself is basically evolving to a technology in its own right with its own other ecosystem and also BRC20 as opposed to being just a store of value. So I think we could see that more of these miners are basically setting themselves up to be conglomerates with multiple revenue streams.
You speak about the evolution of Hong Kong's crypto or digital asset ecosystem. I'm curious because when you speak with some of the major ETF issuers that's names aren't on the list of approved applicants or people that have the approval in principle or companies, one of the key reasons we hear that's keeping people on the sidelines at this point in time is just the lack of a developed infrastructure in Hong Kong. Mm-hmm. What needs to happen next? Is it the banking piece, for instance, that's really missing at this point in time?
Right. You're absolutely right to point out about the banking piece, because at the same time, having been in financial institutions in their journey of adoption in digital assets, I would say that overall there needs to be a lot of infrastructure changes. Again, I do want to mention that it always starts with the top, right? So at the top, of course, you need to have management buy-in. At the same time, you do need to have the government set a very strong framework. And therefore, you're going to see the banks start coming in. And I would say that if you look at just globally, digital assets are the phenomenon. So you do see that in the EU, there's MiCA, which is basically giving a green light to a lot of the European participants. Obviously, US, we're going to see more clarity post-election. And also for Asia, Hong Kong, and also Japan. So we're actually seeing more of these regulators put their vote of confidence in.
All right, Esme, thanks very much for your time this morning. That was Esme Powell there, CEO at Emergent X Digital Asset Insights. And be sure to tune in to Bloomberg Radio to hear more from the day's big newsmakers and get in-depth analysis from the Daybreak team. Broadcasting live from our studio in Hong Kong, you can listen via the app, Radio Plus, or on BloombergRadio.com. We'll have plenty more ahead. Stay with us. All right, some of the latest corporate stories that we're tracking this morning, and HSBC is said to have started a new round of job cuts at its Asia investment bank. Sources say the lender laid off around a dozen bankers on Tuesday. It comes as deal-making across Asia has slowed, especially in Hong Kong and China. Other banks, including UBS and Goldman Sachs, have made rounds of job cuts in Asia over the past 18 months. Country Garden is said to be pushing back some offshore bond payments, despite already getting a round of extensions last year. Sources say its onshore unit plans to extend coupon and principal instalment payments for some yuan bonds maturing in 2026. Last month, Country Garden missed a $13 million coupon payment, triggering a 30-day trading day grace period. LVMH has reported slower sales growth as wealthy consumers reined in spending. Organic revenue at the luxury group's fashion and leather goods unit rose 2% in the first quarter, which is the slowest pace of growth for the period since the pandemic began in 2020. Sales in Asia outside Japan fell 6%, although Chinese demand was higher. Rio Tinto has reported a sharp drop in first quarter iron ore shipments as Chinese demand remains soft. The world's second biggest miner says it exported 78 million tonnes of the steelmaking material, marking a 5% decline from the previous year. Output of Rio's other materials, including copper and aluminium, were more robust. And taking a look at some of the Aussie miners that we're tracking in the session so far, it is that story of just broad weakness coming through for these names. Rio Tinto, as you said, that drop in iron ore shipments in the first quarter of 5%. We are seeing that stock down 0.5% at this point in the session. Broadly, though, when you take a look at how Asian equities or Aussie equities are faring so far, actually it's just a slight bit of upside. But taking a look at the IMAP function, you do see that materials and also energy stocks are the big laggards in the session so far. It is that question around rate cuts as well that's playing into it. We did hear Jay Powell, of course, reiterating that need for patience overnight, caution on the outlook for rate cuts as well, given that last mile of disinflation, Haidi, it is really proving to be very sticky to bring down.
Yeah, as long as needed is the sort of wording that we had from Jay Powell. And take a look at our US futures are kind of coming into the session. We're seeing a little bit of muted upside, about 0.1%. This is kind of seen, as Bell mentioned, potentially as a bit of a shift in his message following a third straight month in which we saw the key measure of inflation beating analyst forecasts, and also really kind of paints a picture of a Fed that sees very little urgency to cut rates. Any reductions this year could come relatively late in the year, if at all. There are still some analysts that are still seeing 2 to 3 rate cuts, though. Coming up in the next hour here, why BofA Securities believes China's equity markets can continue to trend higher, even with a sluggish economy. That is it for Daybreak Asia. Our markets coverage continues. The China Show is next.